Canada is in the most debt ever in history. There has never been a time in which Canadians have accumulated this much mortgage, credit card, auto loans, personal line of credit, and every other form of debt ever. It's the party that never stops. No need to worry, because as long as real estate increases in value forever, our homes can remain our ATM. Uh-oh. You came here for the truth, so let me unveil that for you. Today we are going to look at the debt problem that exists particularly in Canada, but the same problem goes for so many other countries around the world today as we see records breaking every single month. Let's get into it right away. Canadian bankruptcies surge as rising rates hit indebted consumers. This is something that I have been warning about. It's pretty obvious. As the debt increases, you put an interest rate on top of that people simply can't afford to pay, and you have a problem. Rising borrowing rates are creating a surge in Canadian bankruptcy filings. They predict filings in the nation's most populous province will increase by a minimum of 2% to 5% in 2019 and may jump as much as 8% if interest rates continue to rise as housing prices fall. Of course, they try to whitewash the issue here. Don't worry, don't panic. However, we do have reasons to worry simply because of the amount of debt people have taken in their homes, and then they've pulled the equity out of it, and then they've added on top of that home equity line of credit, credit cards, personal line of credit, and every other form possible. Bankruptcies are up in Canada. The head of the Bank of Canada said this week, and he expects they'll rise even more as the central bank continues to hike interest rates. This is coming directly from the Bank of Canada saying, no, you have reason to worry. As interest rates increase, as we plan to do, that is going to put a big brick wall in front of these people. The governor of the Bank of Canada said he hears just how difficult higher borrowing costs can be straight from the people feeling the pain. We're acutely aware that our decisions affect everybody. They affect the financial well-being of everybody, and many Canadians are carrying a high debt load. The interest rate currently is at 1.75%. It is historically near a record low. This is far too low. It's artificially low, but of course they need to keep it here or they're going to collapse the nation. I don't have to work hard to remind myself of that. I get daily correspondence from people explaining to me what their situation is. And of course, they are worried because what I have read is that a $200 difference in their payments is going to crush most people. $200 a month is going to be enough to put them in the dirt. And this is something that people generally don't understand because, hey, as long as they have their job, as long as their bills are being paid, and as long as their disposable income remains present to some degree, whether that's through a credit card or cash in the bank, then everything is fine. But as soon as one of those things is disrupted, people start having a problem. Yes, some of them, they go for bankruptcy. Yes, some of them, they're able to borrow money from somebody else. But when it starts happening on a widespread scale, then you have a big problem. Of course, they claimed that they didn't increase interest rates this time around because oil prices had come down quite a bit. That affected the economy. They didn't want to push it any further, but the intention is to increase interest rates, and of course that will have a major impact on individuals and the amount of debt that they have taken. An increasing number of Canadians can't meet their financial obligations. Another sign rising borrowing costs are taking a toll on household balance sheets. The number of consumers seeking debt relief jumped 5% in November from a year earlier. This is a worrying sign for an economy that has relied so heavily on consumer spending and housing markets to drive growth. Bank of Canada has lifted its key lending rate 5 times since mid-2017. Of course, in time, they will increase interest rates, and obviously we know what's going to happen with that. This is the chart that corresponds to that information. You can see the insolvencies climbing throughout mid-2017 up until present day, and what's interesting about this happens to be the point at which real estate peaked out in Canada. So is it correlated? period, I would have to say so. As long as real estate was increasing in price, the sales were going crazy, people were able to spend as much money as they wanted because they just kept pulling out the equity in their homes. However, something started to change in 2017. The prices started to come down. We see stagnation in certain areas. Then we saw the sales and inventory started to change as well. That story has been told many times before on this channel, so I'll move on. Toronto, Vancouver housing sales plummet to decade lows in 2018. I don't think people realize that where we are at today. Decade lows on the sales, and in Vancouver, I think it moved back to 20 years ago. But regardless, what we're seeing today is the case of houses being too expensive in relation to what people earn. There's no price that is right. Okay, it's right for the people, and right now, this is too expensive for the average person. It's a matter of fact. You can't deny that. Look around. You see what the average person makes or the average household makes, and then you relate that to what the average home costs, and you have a big problem. The two do not correspond, and we can prove that. That is a fact, and you could see several ratios. The ratios I've talked about in my books, but also I discussed it on the channel, a few ins and outs of that. You can see that. You can see what mortgage rates currently are, and guess what? If they continue to increase, obviously there's going to be less people able to afford these homes. They're trying to suggest that things are more strict today, and that's why the housing has come down a bit, but it's really just started to level off, and then of course it will take off from this point. But they're not getting to the root of this issue, and that is, quite frankly, borrowing costs are at a record low or near record low, and still people are having a problem. So unless you bring those down and make it way easier for people to borrow, you can't rise from this point. It's simply impossible. The debt load is too much, and the worse the debt becomes, the longer this goes on, the worse the problem is gonna be in the end. So the faster we get this resolved, the faster we can get asset prices down to realistic levels, then the better off we'll all be. This is something really quick here. Earnings revisions weakened across nearly all sectors except utilities. The sales forecast revision ratio also weakened. The earnings obviously have been an issue, not just in Canada, but in the US as well. Many companies have reported dismal earnings this time around in 2019, but don't worry, buy the dip. Warren Buffett, Amazon, Jeff Bezos, quantitative easing, dovish, Fed, any other term that will trigger the algorithms, that's what you need. So you can buy. China, Canada, and Hong Kong are among the economies most at risk of a banking crisis. That's according to the BIS, the Bank for International Settlements. Canada, whose economy grew last year at the fastest pace since 2011, was flagged thanks to its households' maxed out credit cards and high debt levels in the wider economy. Household borrowing is also seen as a risk factor for China and Hong Kong. This is a problem that's going on everywhere today, and I'm surprised they didn't talk about the United States in here as well. Obviously, we see that going on everywhere. Whether we're looking at London or Sydney or Toronto, it doesn't matter because the problem exists because the borrowing costs are so cheap. People took the maximum amount of debt. They can afford the payments over a 25-30 year period. So they suggested, hey, this is fine. It's affordable. But they don't realize that the debt that they've taken on is too burdensome and they're going to have to pay the price. And the only way you pay the price is the hard way. Canadian household debt hits $1.8 trillion as report warns of domestic risk. There's all forms of credit today. You can get a loan for just about anything. I've mentioned it many times before, and I know you're the same way. Every time you open your mailbox, there's a request to sign up for this. You're pre-approved, $10,000. Here you go, and it goes right into the garbage. And that's the way it has to be. But most people, they start taking that debt. Sure, why not? Free $10,000. I get phone calls. Hello, this is your bank, you're pre-approved for a line of credit. You don't have to do anything. It's totally fine. And then I suggest, no, I don't need it. They say, why? Just take it. It's fine. It's good. You'll like it. And I suggest, no, I don't want to do that. I don't need it. They say, don't worry. You don't have to use it. It's not going to cost you anything. And that's what they do. They try to entice you. They are salespeople trying to get you to take on more debt. Why? Because it's profit. This is a product for these companies. That's what a lot of people don't understand about banks. They think you're there to hold your money in a vault, and that's what a bank is. really is. They sell products. They sell all kinds of products. They have a bank, but it's not just one type of bank. You can get a bank that allows this criteria or a bank that allows that criteria, and each one is a tier, each one is a product. They try to upsell you on new products. That's the way this industry works. There's nothing wrong with it. It's a business, but you need to be aware of exactly how it works so that you don't get swindled, so that you don't end up in the debt trap. This is from Moody's. Even they agree what's happening today. Of course, this was about a year ago, but the problem is actually worse today. Canadian banks face the risk from rising consumer debt vulnerability. They get into the details, of course, but the same problems. Debt to income levels continue to edge up. The first bite into bank asset quality will be felt in unsecured credit card portfolios. We've got derivatives that exist today. Don't be fooled by all of those who claim that things are better off today than they ever have been. This is a big pile of BS. Do not accept this as reality. The derivatives are still a problem. It doesn't matter how big it is. That's where people are at fault. Well, there's less derivatives today, so we don't have to worry. Of course not. That's not how it works. It's not the size of the derivatives that matter. It's the fact that they exist, the fact that there could be contagion, the fact that it could spill out into other assets that are supposedly more strong, more secure, but it's not a problem today because nobody's talking about it. But one day there will be an issue. You know, back in 2007, 2008, there was literally a 3-month period in which they were suggesting everything is fine to, oh my God, nothing is fine. A 3-month period. So that could happen at any moment. Think about that for a second. As we look at the stock market, the TSX in Canada is absolutely terrible. Right now it's sitting at, let's say, 14,500 or so, but look at where it was back in 2007, January 1st. It wasn't much lower, okay? If you take it where it was at the peak in 2008, all right, in that cycle, we see it at the same level it was at the peak as it is today. That is worrisome because it's not even factoring in inflation. I mean, come on. The banking system in Canada was bailed out by the Federal Reserve. We see all kinds of different bailout measures that they took, and of course, they didn't go to the extreme that was experienced in the United States. The housing market didn't come down like it did in the United States, but we still have problems that we can't get over today because of debt. Debt is the core problem, and it's caused by the central banks and the way they have built this system. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education that you were not taught in school, these 2 books have everything that you need. So check them out at the link in the description. I talk about Canada in here, I talk about Europe in here, I talk about basically everywhere, but I really wanted to make this an educational program for people to get the data all the way from the beginning up until what you need to know for today and how to prepare and so much more. Check them out at the link in the description. If you want the audiobook version, you can get that at themoneygps.com.